Hello, 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 and happy Friday. Welcome back to yet another live event where we unpack multifamily underwriting, passive investing, one step at a time. For those who may be tuning in for the first time and perhaps meeting me for the first time, my name is Vessi Kapulian, former commercial lender turned real estate investor, and today I work with business owners, high achieving professionals, and help connect them with well vetted cash flowing investments in apartments so they can create additional income streams and achieve tax efficiencies. I also advise family offices and family enterprises on risk management, due diligence, governance, and next gen transitions and additional family enterprise initiatives. And last but not least, I consult passive investors who are looking to do a deeper dive in learning how to analyze a deal, or perhaps need a one off deal review to help navigate through the complexities of the deal structure and the deal underwrite when it comes to apartments. Now, if you haven't followed my announcements this week, there is something big, big, big coming on December 14th. So make sure to join RSVP and save your spot. I have a big surprise to reveal. There will be without giving away too much, there will be a lot of gifts, a lot of bonuses, especially for those who join live. I will repost the link in the comments to this live event in case you missed it. But it will be my pleasure to host you and see you there. And I know you will enjoy what I have to share based on early feedback that I've received from the team that has been helping me put this together and some of the early adopters. So, without further ado, I want to cover a topic that seems to come up over and over again in my conversations with passive investors, namely the five biggest mistakes I see passive investors do when encountering investment opportunities. And those mistakes can cost a ton of money. Again, when it comes to syndications and private offerings, these investments typically start at $100,000, and in many cases more. So 6 7 figures can be a pretty painful mistake if you don't do your diligence right, and underwriting is part of the diligence progress. But today, I'll quickly cover the top five that I see most frequently, and we'll open it up for questions as usual, and I will wrap it up. So, first, the number one mistake I see is not vetting the operator. The operator, the team that was actually running the deal, a term that's very loosely used in our industry. Other terminologies you may hear is the syndicator, the lead sponsor. Same would apply actually even to the fund manager. But ultimately, who is the key person, or who are the key people, the key decision makers running the deal, operating the deal, and doing your diligence on the people? As a former lender, I used to say that people pay back loans, not necessarily properties. And it really does start with the people first. A great operator can run down a property to the ground, a great looking and performing property, and a great operator, right? So that was a bad operator can turn a really great property into a disaster. But also, a really strong operator can turn a poor performing property into a gem. So that's really, really important. And not simply relying on social endorsements, right, or social media popularity, but really digging in, doing the background check, deep background checks on the key sponsors, understanding their track record, also understanding their business plan, understanding how they and their ability to execute on it relative to past deals, right? How has their actual deals performed relative to their original projections? How do they communicate? How frequently? How openly? How transparently? Do they roll their eyes and get annoyed when you ask a ton of questions? Are they accessible and reachable? Because if they're not during the courtship stage, while you're doing your diligence on you, and they're doing their diligence, while you're doing their diligence on them, and they're doing their diligence on you, then imagine what it would look like once you wire the money, sign the documents, and close the deal. So these are three key areas: the background checks, including references from current and past investors, their track record and execution ability, and then their communication. Number two is not understanding the market. I'd like to say that the market really drives the inputs and serves as the basis for the inputs that drive the outputs or projected returns for any investment. And when I say market, I don't just refer to a certain state, I refer to the city, and within the city, which neighborhood, and in many cases, even which block the property is located at. Because a lot of those market dynamics, like population growth, job growth, median household income, poverty rate, crime rate, and I've covered a ton in prior publications as well as in prior lives. So just DM me if you'd like a link to those. Those drive really the key assumptions when it comes to rents, expenses, the appropriate amount of reserves, and so forth. Which actually leads me to point number three, which is not vetting the assumptions that go into underwriting the deal. I mentioned some of them. Really, the biggest one I would say is the entry and exit cap rate relative to where the market is today, and then the rent um, comps and rent growth assumptions, right? Because with the cap rate, that has a multiplier effect on the exit valuation. So if you get things wrong there, that's really, really, really difficult to make up that gap. And very similar with the rent, getting the wrong base sets you off for a disaster, right? Because you base the future rent growth off of that baseline number, and everything flows down from the top line, right? The expense percents, the NOI, which then in turn drives your not only valuation but also sets the trajectory of your cash flow. And so, really important to vet and validate those through third parties, whether that's a boots on the ground contact that you have, a third party property manager. There are a lot of free sites out there that I've referenced in prior lives. There are paid sites like CoStar that you can tap into and really understand those numbers. Number four is not stress testing the deal. It's not a matter of if, but when things go wrong. And I am yet to see a deal that has performed right on track, right in line, within 99% of projections. Right? Things always happen. It's a business at the end of the day. You have to run. But you really want to understand the spectrum, right? Not just the upside, but what does the downside look like, right? What if vacancy all of a sudden rises to 20%, right? What are we looking at now? What if you cannot raise rents? What if actually rents decline? What if actually cap rates expand versus contract? What does my return look like in that scenario? Especially understanding the downside is extremely important. And sponsors oftentimes perform this analysis. They may or may not necessarily include it in the investment offering presentation, but if they don't, you can always ask for it and they should be able to send it to you relatively quickly. If they don't, that's a pink flag, something for you to think about. Last but not least is not vetting the deal structure. And by that, I'm not simply referencing to the numbers, right? That's the underwrite component of the deal. But what I'm referring to is the fee structure, the promote, the profit splits, the cash flow splits, the ownership percent, specific clauses within the private placement memorandum. I've also covered those in details and happy to send you the link. So just comment below or send me a DM. Um, it's at the end of the day, that subscription agreement that you sign, and the PPM and operating agreement detail the structure of the deal, how decisions will be made, your rights, obligations, and so forth. You really want to understand that, because once you sign again and wire the money, it's a done deal. You cannot be changing them once the deal is closed and up and running. So these are the five: not vetting the operator, not understanding the market, not vetting the assumptions, not stress testing the deal, and number five, not vetting the deal structure, fees, and understanding the private placement memorandum. So just wanted to pop up very quick and summarize those, because they do come very often in my conversations with private investors. And if you tuned in late by any chance and missed the beginning, I will share it again that I'm sharing something big on December 14th. You do not want to miss it. Without giving away too much, there will be a ton of bonuses and free gifts if you join the live event. I will post the link below in the comments, or if for any reason you cannot find it or see it, just send me a DM or comment below. So December 14th at 10 a.m. we'll be streaming again on LinkedIn, YouTube, Facebook. I encourage you to save your spots, because I know you will like what I have to share, as well as the gifts that I have for you. And until next week, I wish you a great day, a blessed weekend, and um, I'll see you again next time. Ciao.